In 1907, the United States went through a financial crisis known as the 1907 Bankers' Panic. Out of necessity, President Roosevelt and Congress devised a system that would aid the economic position. A small group of nationally known financial moguls and politicians gathered at Jekyll Island and created the outline that became the Aldrich Plan for the growth of the Federal Reserve System. Attending the Jekyll Island meeting with Aldrich were prominent European banker and Kuhn, Loeb, and co-partner Paul Warburg, who would later serve on the Federal Reserve's first Board of Governors and whose knowledge of European central banking was crucial to the meeting's success. J.P. Morgan and co-senior partner Henry Davison. National City Bank of New York President Frank Vanderlip. Bankers Trust of New York Vice President Benjamin Strong, who would later head the Federal Reserve Bank of New York. Piatt Andrew, Assistant Secretary of the Treasury. This meeting was held in 1910, and the charter for the Federal Reserve was signed in by President Woodrow Wilson in 1913, developing the United States independent central bank to provide a safe and flexible monetary and financial system. The group worked around the clock, grappling with questions such as who would own the central bank, how many institutions it would contain, and how open market operations would be conducted. In December 1913, the Federal Reserve Act established the Federal Reserve System to remedy the conditions underlying the money crisis that had overwhelmed the country's financial crisis for many years. Congress has amended the Act several times since to develop the Fed's ability to foster a sound financial system and a healthy economy. Today, many economists are critical of the Fed's decisions in the early 1930s because they believe the decisions made by the Feds, declining to make loans to banks based on poor business decisions of the banks, increased the severity of the Great Depression. The U.S. Congress needed to build a financial system that would strengthen America's economy's banking system so America could thrive with the intent of putting an end to bank panics such as the one in 1913. Congress passed the Federal Reserve Act, setting up the Federal Reserve System. The plan envisioned was to construct a central bank that has government oversight yet works independently. The system began operation in 1914, with the authority to make discounted loans to banks. This means it's a central bank that can help keep the economy healthy without pressure from short-term political interests. But the Fed alone doesn't have all the tools to keep the economy growing at a steady pace. The job is not one for a single organization, and there's a difference between monetary policy, the Fed's province that influences the economy by changing the supply and demand of money, and fiscal policy, the province of Congress, which uses tax and spending changes to affect the economy. The Federal Reserve Board of Governors is an agency of the federal government that reports to and is directly accountable to Congress and provides general guidance for the system and oversees the 12 reserve banks. The Federal Open Market Committee, FOMC, make decisions that help promote the health of the U.S. economy and the stability of the U.S. financial system and the Federal Reserve Banks. The Board of Governors of the Federal Reserve System, commonly known as the Federal Reserve Board, is the main governing body of the Federal Reserve System. It is charged with overseeing the Federal Reserve Banks and with helping implement monetary policy of the United States. The 7 members of the Board of Governors are appointed by the President of the United States and confirmed by the Senate to a staggered 14 non-renewable terms. The FOMC is made up of 12 members, the 7-member Board of Governors of the Federal Reserve System, the President of the Federal Reserve Bank of New York, and 4 of the remaining 11 Reserve Bank presidents. Each of these 11 Reserve Bank presidents serves one-year terms on a rotating basis, with the rotations coming from these 4 groups: Boston, Philadelphia, and Richmond, Cleveland and Chicago, Atlanta, St. Louis, and Dallas, and Minneapolis, Kansas City, and San Francisco. Non-voting Reserve Bank presidents fully participate in the meetings by being involved in discussions and assessments of the national economy and various policy options. The FOMC meets about every 6 weeks, for a total of 8 regularly scheduled meetings each year. Additional meetings and telephone conferences may be called as necessary. In establishing the Federal Reserve System, the United States was divided geographically into 12 districts, each with a separately incorporated reserve bank. District boundaries were based on prevailing trade regions that existed in 1913 and related economic considerations, so they do not necessarily coincide with state line. As originally envisioned, each of the 12 reserve banks was intended to operate independently from the other reserve banks. Variation was expected in discount rates, the interest rate that commercial banks were charged for borrowing funds from a reserve bank. The setting of a separately determined discount rate appropriate to each district was considered the most important tool of monetary policy at that time. As the nation's economy became more integrated and more complex, through advances in technology, communications, transportation, and financial services, The effective conduct of monetary policy began to require increased collaboration and coordination throughout the system. The Federal Reserve System is made up of 12 regional banks and 24 branches. The 12 Federal Reserve Banks and their 24 branches are the operating arms of the Federal Reserve System. Each reserve bank operates within its own particular geographic area, or district, of the United States. Each reserve bank gathers data and other information about the businesses and the needs of local communities in its region. That information is then factored into monetary policy decisions by the FOMC and other decisions made by the Board of Governors. 4 Advisory councils assist and advise the board on matters of public policy. Federal Advisory Council. This council, established by the Federal Reserve Act, comprises 12 representatives of the banking industry. The Federal Advisory Council ordinarily meets with the board 4 times a year, as required by law. Annually, each reserve bank chooses one person to represent its district on the Federal Advisory Council. Federal Advisory Council members customarily serve 3 one-year terms and elect their own officers. Community Depository Institutions Advisory Council. The Depository Institutions Advisory Council was originally established by the Board of Governors to obtain information and views from thrift institutions, savings and loan institutions and mutual savings banks, and credit unions. More recently, its membership has expanded to include community banks. Like the Federal Advisory Council, the Community Depository Institutions Advisory Council provides the Board of Governors with first-hand insight and information about the economy, lending conditions, and other issues. The Federal Open Market Committee formulates the nation's monetary policy. The voting members of the Federal Open Market Committee consist of the 7 members of the Board of Governors, the President of the Federal Reserve Bank of New York and presidents of 4 other reserve banks who serve on a 1-year rotating basis. All Reserve Bank presidents participate in the Federal Open Market Committee policy discussions whether or not they are voting members. The chairman of the Board of Governors chairs the Federal Open Market Committee meeting. The Federal Open Market Committee typically meets as stated before, 8 times a year in Washington, D.C. At each meeting, the committee discusses the outlook for the U.S. economy and monetary policy options. At the conclusion of each the Federal Open Market Committee meeting, the committee issues a statement that includes the federal funds rate target, an explanation of the decision, and the vote tally, including the names of the voters and the preferred action of those who dissented. To implement the policy action, the committee issues a directive to the New York Fed's domestic trading desk that guides the implementation of the committee's policy through open market operations. Before conducting open market operations, the staff at the Federal Reserve Bank of New York collects and analyzes data and talks to banks and others to estimate the amount of bank reserves to be added or drained that day. They then confer with Fed officials in Washington who do their own daily analysis and reach a consensus about the size and terms of the operations. Then, a New York Fed official sends a message to the primary dealers to indicate the Fed's intention to buy or sell securities, and the dealers submit bids or offers as appropriate. The minutes of each Federal Open Market Committee meeting are published 3 weeks after the meeting and are available to the public. Occasionally, the Federal Open Market Committee makes a change in monetary policy between meetings. While the Federal Reserve Bank presidents discuss their regional economies in their presentations at the Federal Open Market Committee meetings, they base their policy votes on national, rather than local, conditions. The goals of monetary policy are to promote maximum employment, stable prices, and moderate long-term interest rates. The long-term real rate of interest is the interest rate that is most relevant when savers consider purchasing a long-term financial investment such as a corporate bond. It is also the rate of interest that is most relevant to firms that are borrowing to finance long-term. By implementing effective monetary policy, the Fed can maintain stable prices, thereby supporting conditions for long-term economic growth and maximum employment. The Federal Reserve's monetary policy goals, as prescribed by Congress, are the 4 main monetary policy goals to promote a well-functioning economy are to price stability. Rising prices erode the value of money as a medium of exchange and a store of value. Maintaining the highest employment rate, high employment or a low rate of unemployment is an important monetary policy goal. Maintain stability of financial markets and institutions. Firms need access to funds to design, develop, produce, and market their products, and economic growth. Policymakers aim to encourage stable economic growth, which allows households and firms to plan accurately and encourages firms to engage in the investment that is needed to sustain growth. The Federal Open Market Committee sets U.S. monetary policy in accordance with its mandate from Congress, to promote maximum employment, stable prices, and moderate long-term interest rates in the U.S. economy. The Fed also conducts the nation's monetary policy by managing the level of short-term interest rates and influencing the availability and cost of credit in the economy. Monetary policy directly affects interest rates, and it indirectly affects stock prices, wealth, and currency exchange rates. Through these channels, Monetary policy influences spending, investment, production, employment, and inflation in the United States. Effective monetary policy complements fiscal policy to support economic growth. Prior to the financial crisis that began in 2007, the Federal Reserve bought or sold securities issued or backed by the U.S. government in the open market on most business days in order to keep a key short-term money market interest rate, called the federal funds rate, at or near a target set by the Federal Open Market Committee. To support the economy during the financial crisis that began in 2007 and during the ensuing recession, the FOMC lowered its target for the federal funds rate to near zero at the end of 2008. It then began to use less traditional approaches to implementing policy, including buying very large amounts of longer-term government securities to apply downward pressure on longer-term interest rates. In addition, the Federal Reserve's communication of its assessment of the outlook for the economy and its intentions regarding the federal funds rate became a more important policy tool. In the fall of 2014, with the economy having made substantial progress toward maximum employment, the Federal Open Market Committee announced key elements of its plans for normalizing monetary policy when appropriate. In December 2015, the Federal Open Market Committee decided that economic conditions and the economic outlook warranted starting the process of policy normalization and voted to raise its target for the federal funds rate. While the Federal Reserve's monetary policy goals have not changed for many years, its tools and approach to implementing policy have evolved over time. At times, the Fed encounters conflicts among its policy goals. The Fed can raise interest rates to reduce the inflation rate. But higher interest rates typically reduce household and firm spending, which may result in slower growth and higher unemployment. So, a policy that is intended to achieve one monetary policy goal, such as reducing inflation, may make it more difficult to achieve another policy goal, such as high employment. The Fed tries to keep both the unemployment and inflation rates low, but it can't affect either of these economic variables directly. The Fed cannot tell firms how many people to employ or what prices to charge for their products. Instead, the Fed uses variables, called monetary policy targets, that it can affect directly and that, in turn, affect variables, such as real GDP, employment, and the price level, that are closely related to the Fed's policy goals. The two main monetary policy targets are the money supply and the interest rate. The Federal Reserve, our central bank, is one of the country's most powerful economic institutions. The Federal Reserve is relevant for Congress not only because the Constitution gives monetary powers to Congress but also because Congress created the Fed and, therefore, has critically important responsibilities for Federal Reserve oversight. Most economists recognize that total spending or aggregate demand is determined more by monetary policy than by fiscal policy. In other words, if Congress passes tax or spending legislation intended to affect total spending or aggregate demand, these effects can be fully offset or outweighed by changes in monetary policy. Federal Reserve monetary policy is also the key determinant of inflation and also influences interest rates which affect key interest rate sensitive sectors of the economy such as housing, autos, and investment. More specifically, the Federal Reserve influences interest rates by manipulating reserves to stabilize the economy. Lastly, the Federal Reserve is committed to ensuring that consumer and community perspectives inform Federal Reserve policy, research, and actions, with the mission of promoting a fair and transparent consumer financial services marketplace and effective community development, including for traditionally underserved and economically vulnerable households and neighborhoods.